All right, Scott Sipprelle is a former investment banker and hedge fund manager who may be best known as the man who began the campaign to kick Phil Purcell out of Morgan Stanley's executive suite. He is now a newly published author of a novel about Wall Street called The Golden Dog, and he joins us now with his assessment of the financial market, which, Scott, I think probably more important is the fact that you closed your hedge fund at sort of the top of the industry, Copper Arch Capital. I think it was November of 2007, right? Because you thought people were encouraging you to take risks that seemed a little bit too crazy.
Well, I got out of the business for two reasons. And by the way, thanks for having me on. First reason was I was a little bit burnt out of the business of dollars and cents, black and white, winning and losing, and had some other passions I wanted to pursue in life. Second reason, I was scared about the financial climate. I thought the boat had tipped too much to one side, and many of the things that people were wanting me to do in my fund weren't necessarily what I wanted to do.
When I hear that, and I have read that in a synopsis of your career, I wonder, what did they want you to do?
They wanted me to take more risk. And you don't get paid big bonuses on Wall Street for prudence. And that's why the recurring cycle of scandal and boom and bust tends to be etched into the history of the island. And I try to put some of this into my story here, which also traces a different crash, actually one that started in 1987 when I began my career on Wall Street.
But others continued to take more risk, and you know how that turned out for hedge funds in 2008. What were the specific investments that you thought just too crazy?
Well, I remember in the spring of 2007, I met with a large financial services company and talked to their risk management group. And of course, every big investment bank, insurance company, commercial bank had lots of strategies and a lot of technology explaining how they would be able to get out. And I saw in that portfolio a significant concentration in risk and leveraged risk and illiquid risk. And it struck me that if the whole world was doing the same trade, it was going to be difficult to extricate that without a lot of pain.
It's interesting, actually, and you point out that your book is centered around the crisis from 1987, but it doesn't seem much different than the crisis of 2007, right? Because the same sort of herd mentality was going on then as we saw happen. Why do we see this repetition on Wall Street?
Wall Street is a great laboratory for studying human behavior. My view is it tends to accentuate the qualities that we already have. So if you're brilliant, you're going to be uber brilliant. If you're devious, you're going to be even more devious. If you're a comedian, you have an even bigger stage for your gags and jokes. And if you're a risk taker, you will be rewarded for taking more risk until the tide goes out, in which case you will be punished for doing the very same strategy which made you successful in the first place.
I got to ask your take on John Mack, because you were so involved with Morgan Stanley. Was he too much of a risk taker, or was he the right guy to lead the ship there?
I'm here to talk about the book, actually. I think Morgan Stanley has done a fine job, actually, of getting the house back on track. I don't follow the company like I used to, obviously, as an investor and a client of the firm, but I think the firm, the results speak for themselves. The firm seems to be back on track.
All right, well, everyone, I'm sure, wants to read the book, and how much can you tell us about it without giving away the ending?
What I can tell you is that it's really a response to a lot of the questions I get from friends, neighbors who say, what went wrong there? And you know, the typical answer you often get is subprime mortgages or FAS 115 restatements. But the reality is it's all about the people. The details are in the people. And so what I try to do is to study the personalities and the decision-making process and what happens when trades are being put on, or how hedge fund managers short stocks, or what is the process around which this carnival of capital, which is how I refer to it in the book, actually takes place. And as you pointed out in your earlier comments, these tend to be recurring cycles which are driven by patterns of human behavior.
By the way, you know, is the cycle... you're interested in venture capital now for a lot of interesting reasons. For one thing, you say there's so many ideas to choose from and not as much cash there, so you have the ability to choose. Did the same thing happen in 1987? Is the same thing going to happen again? I mean, is that part of the cycle as well?
My view, my personal investing view, is that this cycle is in fact different, and that the era of very bold risk-taking has in fact been replaced by something that will come to look like a much more risk-controlled environment. So my view is that the best opportunities are actually in smaller companies, private companies, startup companies, and that's where the innovation, that's where the creativity, that's where the research is going to be that hopefully is going to take us out of this in the long run.
All right, Scott, thanks so much for joining us. Scott Sipprelle, author of The Golden Dog.